apparently the way you become one of the most popular, if not the most popular, personal finance commentator in America is just to spout off nonsense angrily. So I think I have a chance, Doogles. This could be me in 15 years.
I think it's you in 15 minutes.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Hello, sir. How are you?
A little frustrated with you.
Yeah, see that's why I'm being ever so kind to you. Henceforth, good sir.
Good day, chap.
This was one of those I came on, and Skippy says, "I got beef with you," and I'm like, "What beef?" He goes, "If you don't know what beef I have with you, then you don't really love me."
You know you're making stuff up, but I mean, we both traveled this week, and then I had to I had to follow the Jim Harbaugh stuff. I've had a busy week, man. There's plenty of frustration on my plate.
No. You don't even know frustration until you bring up Dave Ramsey.
I do, because apparently the way you become one of the most popular, if not the most popular, personal finance commentator in America is just to spout off nonsense angrily. So I think I have a chance, Doogles. This could be me in 15 years.
I think it's you in 15 minutes, if we're being honest. And why not just be honest about this? Dave Ramsey has built this career. He's come up a lot more on this show than I thought he would, by the way. He's built this career of providing advice, financial advice, personal financial advice to people. How do you get out of debt? How do you build your savings? And now he's starting to venture into the world of how do you invest? And none of it, like 0.00% of it, is not dangerous. I just gave a lot of negatives there. So let me just be clear. It's stupid. Is it not stupid?
Yeah, I mean, so what's going on here is the epic 9-minute rant where his co-host kindly tries to, okay, if you guys have 9 minutes and want to be depressed, just watch this video and watch his co-host, who obviously is employed by him and livelihood depends on him. Watch how terrified she is to try and correct something that she obviously knows is wrong, because she tries to jump in 3 times and he just yelled over top of her. And then she bites her lip and goes home. It's like, really, you could see so much of the dynamic of his company, which has been well documented and has a incredibly poor track record of treating people with respect. Here's what he said. He has this one index fund that he really likes, which charges really high fees that benefit him, that happens to have a decent track record. The decent track record happened, like, this is from memory, but like 30 years ago. So for all intents and purposes, it's slightly outperformed the S&P 500 over a significant period of time. It hasn't done that recently, and it won't do that in the future. I'm happy to say that because it charges high fees. But so whenever he talks about investing in stocks, he say you can make 12% a year. Maybe you can, maybe you can't. The price of admission with investing in stocks is the volatility and the fact that, yes, on average, you might be able to make 12% a year, but you have some years where you're down 30%. And you have some years where you're up 20% and then up 40% and then up 10%. Like, this is what happens. So how do you even talk about this, Doogles? What made him so mad that he had to call everyone in the finance community that actually does math an idiot? Like, he went out of his way to insult people and say they live in their mom's basements when they just are doing sound analysis of retirement withdrawal rates. What do you know why he's got so angry about all this?
Oh, no. I mean, he just gets angry. I think sometimes people just start getting angry. I don't know. But the thing the common rule of thumb that is provided is that you take 4% out of every year out of your retirement fund when you're retired in order to live on. That's the common rule of thumb. Now, that rule could not apply to everybody because everyone's situation is different, but that's the common rule of thumb. Somebody calls in, states that common rule of thumb, and Dave Ramsey gets angry. But I want to read. Can I read a little bit here from what he says?
Mm-hmm.
If you're making 12, that's what you were talking about. If you're making 12 in good mutual funds and the S&P has averaged 11.8, and if inflation in the last 80 years has averaged 4%, if you make 12 and leave 4% in there for inflation, that leaves you 8. So I'm perfectly comfortable drawing 8. $1 million should be able to create for you $80,000 income, boys and girls, perpetually, like forever. You should be able to pull 80,000 forever and never destroy it. So what he suggests, what he demands of people is they take 8% out of their retirement every year. Almost unequivocally, this will bankrupt you.
No, this has a 43% chance of bankrupting you over
almost unequivocally.
Hey, don't be like him. Don't be just making random stuff up and screaming it into a mic. It's basically a coin flip. There's some really good analysis because this fired a lot of people up. There's some really good analysis. Now, Doogles, let me get the caveat out of the way. I like the book Die with Zero by Bill Perkins, which has different approach that says your goal in life is not to have a 100% guarantee that you never spend down your money and live your entire life in fear saying, I have all this money, but I can't enjoy it. Like if you twist your mindset to say, you know, I want to be more risky than average because I want to actually live my life, we can have a conversation about a withdrawal rate greater than 3 or 4%. But that's not what he's doing here. He's misinterpreting the math on 1,000 fronts and actually providing guidance that says that there's effectively a 0% chance that you run out of money if you take 8% out of your investing account. On top of that, he's also making an assumption that you should have 100% of your money in a large cap equity fund, which is also insane. Like basically no diversification. Saying that the S&P 500 is where you put 100% of your nest egg to get that 12% return is maybe the most insane of all these takeaways.
This is partially, so my unequivocally was probably too strong. The reason I stated is because the 43% number in the math that you're talking about is in a particular scenario. I'm saying that generally, if you take, what do you think the average person is pulling in their retirement account? It's not this. It's not 12% a year.
Yeah, it shouldn't be.
Yeah. So I'm saying if the average person were to take out 8%, I would bet you're going to get much higher than a 43% failure rate on this, because you're probably talking more in like the 6 to 7% you're making every year.
No, I can send you the numbers on that. A lot of people broke down like
okay,
basically Monte Carlo simulations of this happening over the past 130 years with an 8% withdrawal rate.
Okay, so like
it's a coin flip.
Person. Okay.
Yeah, it's
That's
a coin flip. If you were comfortable putting 100% of your retirement savings in like large cap equities, like in an S&P 500 fund, which has all sorts of other problems, because if you happen to be retired in a period that mirrors the Great Depression, your total wealth goes down like 30% one year, 40% the next, and all of a sudden you had $1 million and now you have 300K. In that scenario, if you withdraw 8%, you obviously go bust because your wealth evaporates in 2 to 3 years. So that's the main reason why in a smart retirement savings account, you're going to own different types of assets that are less volatile to manage your risk.
So it's not $80,000 a year forever, is what you're telling me.
No, not at all. If you had 100%, I mean, I didn't feel like I needed to do numbers, but maybe I will. If you had 100% of your money in the S&P 500 equivalent, I know it didn't exist in the Great Depression, like in 1929, you have $1 million. According to this Yahoo, known as Dave Ramsey, you could pull out $80,000 a year in perpetuity. Well, 2 years later, when that $1 million is now worth 400K, and I don't even know the exact drawdown percentages off the top of my head, even if you're still pulling 8%, you're not pulling
Yeah,
80K out of
no.
this thing. You're rolling like 36. And
And so broadly, I mean, this gets back. We talked a few times about listening to gurus blindly, and we talked specifically about Dave Ramsey. And there are lessons you could learn from Dave Ramsey about a whole bunch of things. This is not one of them that you should take away, is what we are saying.
I'm ready to go maybe further than that. I almost think you can't listen to anything he says. I admired the his strategy for getting people out of debt because I think that's worked for a fair amount of people. But at this point, for all I know, he's buying reviews that say that works. Like I haven't seen anything he has a strong track record of not being honest and not being truthful. I I'm ready to say you don't believe anything he says. What's maybe worse than all this is one, he's already gone bankrupt once. So I don't know that your financial guru is a person that's gone bankrupt. Two, he diverts his people to financial advisors that charge ridiculous fees and mutual funds that actually rob people. The track record here is about as bad as it gets, Doogles. Oh, and he doesn't treat people that he works with respect. He bullies people with lawsuits if they say something different than him. I think we can move on. I just don't think he's believable in any way, shape, or form.
All right, let's end the Ramsey talk on that note. What you got in the fishbowl?
You got me all fired up over here. I'm pretty excited about my portfolio. I'm pretty excited about small cap stocks. I'm pretty excited about value stocks. I'm pretty excited about even some debt instruments, which we've talked about. There's corporate debt is now intriguing. I got to pull this up. I sent it to you. There's this real life example of a stock, this mining stock. It's called Ramaco Resources in Sheridan, Wyoming. Just want to ring a bell with you, Douglas?
I mean, I know you sent it over to me, but I try and ignore these things.
Okay. The thing I find fascinating about the stock is it allows us to do a real life example of probabilistic outcomes. And I think that could be a really good lesson for people in terms of how you make decisions in life. And this is a super easy example of it. So the Wall Street Journal Thursday, published this article that says a $2 million mine might hold a $37 billion treasure.
Mm-hmm. Yep.
Too good for a value investor not to read, right? Long story short, this Wall Street banker named Randall Atkins bought a mine years ago for $2 million sight unseen. It was just like, here's a mine. It has some stuff. It's probably worth more than $2 million. He buys the thing. He runs the company and is making a decent profit. The market cap of this company, which is METC, has been hovering around 500 million to maybe $1 billion. So clearly is worth more than the 2 million he paid for it. Mining some boring types of coal or something. They think they found something that's more exciting, and they came out with their Q3 earnings saying that they found rare earth metals potentially. Rare earth supplies, which are largely found in China, and it's a big deal relating to batteries and everything else.
Yep.
Long story short, if there's rare earth minerals in this mine, it's not worth the current market cap of $1 billion. It's worth potentially $37 billion. So I dig around with this. It's clearly a coin flip at best. Like they have enough information. They have some samples that have been verified to have this much more valuable material, but there's no real proof, right? But they did have enough to go out in Q3 and say like, there's a potential to happen here. I look at a stock like this. I did a back of an envelope analysis, and to be clear, I haven't bought it yet, and I doubt I will because it's a leap of faith. But here's how I do the analysis. Actually, before I walk you through that, let me shut up and let you jump in with some thoughts on this.
I have two main thoughts, both of which are just you're a bunch of nonsense is what both of these come down to. The first thought is this: why must you think about or buy anything that involves the word Kohl's?
Such a good
My
point. Um,
my sec
this is why
my
I talked
second
to you. I'm not. Yeah.
because I think you got some subliminals going on that are just, you see the word Kohl's and you have to buy it. My second thought is when you pitch this as a like something a value investor would want, but then if you abstract out the commentary that you're making, it sounds more like a speculation. But basically, here's what I hear you're saying. You go, there's this thing that's $12 million, or sorry, it costs $2 million. That could potentially be almost $40 billion. If you picture the future, if you imagine that it has things that it does not have, am I wrong? Because usually when you come to me, you're saying this thing is spitting out.
You're wrong, because when we talk about Twilio and you take me to the future and you're like, oh, in the future it's going to make money, but it doesn't. What's potentially happening with this model that's so fascinating is I'm not saying anything changed. All that potentially happened is there were really valuable minerals that had always been there that this company has rights to that no one knew about. So the value of the stock has the potential to go up 37 times. Anyway, that's not the interesting point. Here's the interesting point. You can write down an equation. You can assign probabilities, and you can come out with a probabilistic value and then say, am I willing to make that bet or not? So if I was going to make a bet in this, one, it would be tiny. But two, here's what I'd do. I'd say, for the past 5 years, the thing's been trading around 500 million, pays a 5% dividend or something. That's probably the fair value of this thing. So there's a 95% chance that this company is worth 500 million. But there's a 5% chance that this company might be worth 37 billion. Do all the math on that? And do you know what? Because I did this on a napkin last night.
Yeah.
Do you know what the probabilistic value, if you believe those percentages of this company, should be?
Tell me.
$2.3 billion. It's currently trading for like less than $1 billion in market cap. So you could very easily get to that point and say, hey, I know that I'm taking a little bit of swag, but at least you have a sound process to say that, in my logic, this could be a value stock because I have a margin of safety of more than a half. Now, I certainly don't expect that to happen. But man, when's the last time you had a 37 bagger? Huh?
It's been a while. It's been a while. All right, so
I forgot to give all the usual caveats. This is not investment advice. This would be a research recommendation. It was on the front page of the Wall Street Journal.
No.
Like it hit me in the face. Like they're honestly allowed to write this headline that says the stock is 37 times undervalued. It's hilarious.
I get it, and just giving you a hard time. I just picture the world where someone comes in and pitches you and says, I have this thing that may have assets that I don't know about, that you don't know about. To be honest, the assets don't know about these assets the assets might have. And if these assets are had, it is worth 37 times what it's worth right now. Yeah. Can I have your money? And you go, probabilistically, yeah. Like, okay, sure. Whatever you want to do. Whatever you want to do. Okay, I'm going to read you this quote. I'm switching gears a little bit here.
Yeah.
I'm going to read you this quote. I don't know exactly where this quote comes from, but I know somebody sent it to me. I know it comes from a Bloomberg piece, and I have speculation as to where it comes from, but I don't want to assign it to the wrong place. But I just think it's kind of fascinating and not wrong. Here it goes. The late 2010s were weird, man. If you were a founder with perfect foresight and you had a fully informed choice between grow sustainably, make money, and have a profitable business that lasts for centuries, and number two, grow way too fast, get that sweet SoftBank money, and flame out extremely publicly in a couple years, I think that the objectively rational choice would still be to take that SoftBank money.
Ooh, is this Adam Neumann?
I believe it's from a Bloomberg piece that is about Adam Neumann. I believe, but I don't have a Bloomberg account here, so I couldn't like click into it to verify. But I think that's what it's from.
Yeah.
And this, what I read this is, I think this might be right, and two, you love talking about incentives. When we set up in a system where that is the incentive structure, how messed up is that? Where objectively, let's just imagine this true for a second. Objectively, the choice that a person should make is to take money, make irrational, non-probabilistic bets, flame out, and they would be better off if that's the case than if they grew a sustainable, money-making, profitable business. Messed up.
Man, so I wasn't even gonna go here, but I was at a conference this week, and there are lots of great speakers. Fun event. One of the individuals that I had never heard of before is a venture capitalist named Bryce Roberts, and I don't know much about his background, but he currently runs Indie VC. Have you ever heard of this guy?
I don't think so.
What was so fascinating about his talk is he effectively said venture capitalism is kind of dumb, even though I'm a venture capitalist who's made lots of money. And it was the exact opposite of this quote. It was like the smart founders going forward may take $3 million in seed money, but they should get to profitability as quickly as possible. He had this huge quote on the 100-foot screen that said, for startups, black is the new black, right? Like you should actually make a profit.
Yep.
Then you should, once you start making a profit quickly after the seed funds, you should keep all the equity to yourself and run like Zapier. I don't know if you know that company, but they took seed funding and now they're worth multi-billion dollars and the founder owns like 75% of it. Now, the reason that's a compelling case right now is because it's a lot harder to raise funds. So you don't have the option. Like SoftBank doesn't really, they're not out there writing the same type of checks. But I'm naturally inclined to this. And I had a chance to talk to Bryce a little bit to just say, one, I think you're right. But two, I think you're insane because you're a venture capitalist. And he kind of owns up to that. What do you think about it? He also talked to me specifically about the fun part about that, if someone actually does take a small check from him, is they get to profitability quick and they don't dilute him like crazy.
It's playing a different game. Because the game he's not playing is the put a whole bunch of bets out there and you make money off the ones that end up crushing. Because he's kind of not betting on stocks that crush, right? He's betting on stocks that do very well and that he's not diluted from. That's different than you're trying to get the next $100 billion business. And so it's a different game is basically what he's playing there is what I would say. I've never seen that game played, so I don't have a lot of view in it, but like that doesn't sound like a venture capitalist. Like I think there's like a different term for that. That sounds more just like a small business investor.
Yeah, interesting. Yeah.
You know what I mean? Like that's what, and I know these are just terms that we're throwing out, but generally in venture capital, like you are looking to grow companies that are going to go public at high valuations or get bought at high valuations. Like that's the game that's generally played. But it might just be terminology that I'm kind of making up here, but that just sounds like someone that wants to invest in a small business that's going to make money for them. And like, there's nothing wrong with that. It's just different.
Yeah. Anyway, I didn't mean to steal your thunder. So back to your point.
Oh no, I think it's not stealing thunder. I think it is a part of the same general point that the incentive structure that's been built is one where we are telling you, entrepreneur, that you personally could be better off by swinging so hard for the fences that even if you strike out, even if your business strikes out, you will do particularly well. That is the incentive structure that was developed.
And that's fairly ludicrous because the guy that the founder, I shouldn't say guy, he or she, that runs or creates from scratch a company that starts doing 500 million in revenues at 25% margins. That's an impressive feat. But someone like Adam Newman, because of his mindset, maybe, but also because of the amount of money he raised, a company like that wouldn't even get the VCs like a decent return on their funds. So it became this binary game of all or nothing. Like you have to be the next Google or it's a failure. And I just see a lot of middle ground here. You said small business before. I think there's some truth to that. I'm fine with mid-sized to large business, but if you raise too much money, you're just at the mercy of the people who wrote you checks.
Yeah, no, I fully agree. It's definitively a balance that you have to strike here. And there's also when we talk about profitability, there's a difference between understanding that a business could be profitable, but you are investing in growth, and not knowing whether a business could be profitable.
Yeah.
And you are investing in growth. Those are also two very different things.
I think the last decade, there's been a lot of companies that don't honestly know if they can become profitable, but are investing in growth because it was so easy to get the next check. When you're like on Series H, it gets a little crazy.
It does. It really, it really, really does. Right. Because then anyway, I could go down into the preferences, liquidity preferences and whatnot, but we don't need to go down that road. It does become quite wild.
Yeah. So my fishbowl is that I'm hoping I can get you to talk about something. I know you had an encounter with Isiah Thomas this week. And I did. I'd really like to yell about it.
You want to yell about that in particular? So to give
how about
some
you tell
context
us about Isiah?
This is not about Isiah in particular, but I will drop one thing on Isiah. But Forbes had the first inaugural event called Forbes BLK, which is an event for Black professionals, Black leaders in the space that Forbes ran. It's pretty cool. It was I'd say it was awesome being in a space like that. It's so rare to be in a space like that. And it leads to things I do not see at typical conferences. I'll give you two examples. At a typical conference, somebody's on stage and they say something that resonates with the audience. And I hear like a soft clap that gets a little bit louder. That's what I hear.
Yeah.
This conference, somebody says something resonate with the audience. Many people ran up the aisles to the front and started like in Baptist church style, waving their hands. A couple of people might have fainted. I mean, it was amazing. It was amazing. At the like happy hour, like that happens right after the conference. It was mood lighting. It had like bomb music. The electric slide happened within 6.5 minutes of this thing going on. No. There was an electric slide going down. I promise you, it was so phenomenal. Anyway, awesome event. Isiah Thomas was there and talked about how he started his business, Isiah International, and started it from the time he was still playing basketball. And so he just discussed that and what it's like to be in business and all this other stuff. And the thing that he said, though, that surprised me was, so people are probably familiar, about 3 years ago, in 2020, The Last Dance came out about the Bulls run in the 90s. Isiah said that The Last Dance is the way that he found out that he and Michael Jordan had beef. He's like, I didn't even know. I didn't know we had beef. And then I'm asked he said, like, Michael called me to ask me if I could be in this. And I was like, yeah, sure, of course. He goes, and then I'm in this show. And through this show, I learned that me and this dude have beef going back 30 years. I was just like, that to me is fascinating. Absolutely fascinating.
It's fascinating because it's a lot about how the human brain works, because I knew that MJ had beef with Isiah Thomas. And like, listen, I've only been to the United Center in Chicago one time. I mean, he got him kicked off the Dream Team, didn't he? No, Jordan.
He said he found that out from The Last Dance. Isiah said he found that out from The Last Dance.
No, I mean, Isiah, come on, man. I want to console him, put a little arm around him and be like, dude, the signs were there. You missed it for 30 years. Jordan hates you. And clearly Well, no, I shouldn't say that. Jordan has his own idiosyncrasies. I was gonna say clearly that Isiah did something to deserve this, but that might not be true. Isiah could have like tied his shoe wrong, and Jordan's so competitive, he would have been like, I will crush that guy for the next 30 years and make a documentary about him that makes him look bad. It's very possible.
It's very possible. Because he was saying, like, when Jordan came to Chicago, his family was helping him out. He's like, he stayed with us for a bit. So like he was describing this as if this was a situation in which the families were close. We were friends.
Wait. In 1983, when Jordan gets first drafted, something like that.
Maybe. No, I don't. You know, so I think the point you're going down is like this is before elbows were thrown between the Pistons and the Bulls. Like
yeah,
there's a lot that happened.
They might have been buds. They might have been buds. Jordan's rookie year. It disintegrated a little bit after that. Maybe when your team was like tackling him on the court and trying to kick him in the junk, maybe that is when things would sour.
Yeah. The other thing he said was that there was some time where he mentioned who the greats were in the 80s. And he said Magic Johnson, Dr. J, Larry Bird, then there might be some, and Kareem. Mm-hmm. He goes, and Jordan wasn't on that list. Because Jordan,
in the 80s.
That's what he said. He goes, Jordan came in the 90s. That's the 90s.
Jordan didn't even make it to the but he didn't. But he was in a couple of Eastern Conference Finals in the late 80s before.
Yeah.
And
he's saying, but apparently leaving him off that list was a problem. He was very calm. He was standing up on stage very calm. So it was a cool event. It was a really cool event. I'm happy Forbes did it. I hope they keep it up because I think there's a lot of power to it. Very happy about that. Speaking of a lot of power, can I talk about zombie companies?
Please do. So your investment portfolio?
You're not wrong. Let's talk about zombie companies. So we've mentioned this at a higher level before, where the broad definition of a zombie company is a company that is only around because they are able to take out debt. Like debt is keeping them around. And there's this study, The Rise of the Walking Dead, zombie firms around the world, done by a couple people out of the IMF, the International Monetary Fund. And what they looked at, one of the things they looked at was the number of zombie companies. Looked at this across about 60 countries, and it was almost evenly split between what they're calling advanced countries and emerging markets. And they looked at the number of zombie companies and the state of those zombie companies. And there are just a couple points that I want to raise here. One point is how they define zombie company, because we gave the definition at a high level. So I just want to say how they defined it. And then one little observation that's not entirely surprising, but I think it's telling on the change in the number of zombie companies if you compare 15 years ago to today. And today, I think they ended the data in 2022. So those are two things I want to highlight. First, they look for companies with interest coverage ratio below 1. Mm-hmm. So you can't pay the interest on your debt. The leverage ratio is above the median in the same industry, so the percentage of debt they have. And they've experienced negative real sales growth. So those are the three indicators they looked at. And those things had to persist over 2 consecutive years. So
these are easy stocks to short if you wanted to short stocks. I mean,
as long as you're not in South Korea. As long as you're not in South Korea. Yeah. I joke about that because South Korea has just banned shorting for some period of time. I mean, I think that's the point is, like they're saying, these are companies that had they not been able to get cheap debt would have gone out of business. So if you take those three things, you say you have a high percentage of debt, you can't afford your interest rate payments, and your sales are going down. So your ability to be able to generate money to pay them in the future does not look very promising. So that's how they defined it. And they looked at both listed, so public, and private companies. Here's some numbers. And this is by percentage of companies here. So if you let's go back to 08. Because 08, it was going down, right? Mary J. Blige was singing up a storm in 08 about how it was going down. In 08, on the private company front, they have a 2% of companies were zombie companies. And listed is about 6%, little under 6%. That's an 08. Everything was melting. The world was coming to an end. 08. Then you go, actually 2021 was the last year they have. You go to 2021, which is not even today. Today would be even worse. Over 10%. So nearly double on the listed front. And private is almost 6%, nearly triple. Mm-hmm. When I say fry, you say to me.
Okay? I mean, you.
Okay.
You act surprised. Of course this happened.
Did I not say to you, we were comparing this to 2008?
No, but so the reason why there's more in 2021 is because there's access to cheap debt. It'd be one thing. Now, I'd love to see the like real-time number in 2023. It doesn't exist because this analysis is hard. That would be fascinating because we seem to be at the cusp of maybe something happening. Something already happens in terms of the change of interest rates, which would
exactly
impact this equation.
If a company could not afford its interest rate payments in 2020 when your interest was 0%, then when your interest, assuming, I don't know, whatever their debt was, let's just assume you take on more debt. When your interest is 5%, hasta la bye-bye. This is not going to...
You absolutely can't afford it.
Yeah, it's just... So, anyway, a little bit of doom and gloom. It's all good, but interesting analysis.
Bankruptcies are up. These zombie company numbers might be down. I haven't seen a study that ties all the puzzle pieces together, but like there might be less zombie companies now than there are in 2023 because some of them have shut their doors in the past 6 months.
That could be true. That could very well be true. But that this is looking at percentage of companies, so it still would be interesting to see what the percent of companies is, even if the absolute number goes down. But I would be curious. But again, like you said, you have to have some historical data to run this. So they could probably run, if they wanted to run this, they'd have to wait until next year, a few months to be able to run it again. But I'm very curious. But to your point, you said I should not be surprised because of zero interest rate. Yes, and you can see the impact of that. And here we talked about the incentive structure that created for startup founders. And now you're looking at it for public companies. Even worse for public companies. I tell you. Oh my goodness. Anyway.
I actually, it's so funny. I think that zombie companies analysis kind of mirrors commercial real estate. So commercial real estate before COVID had high occupancy. So it's probably like high occupancy, low debt. So you could cover, you could pay your bills. And then COVID happened, your occupancy goes down. So even at current interest rates, you might not be able to pay your bills. And then interest rates go way up. And you're seeing those properties turn over a third of their previous sale values. Okay. So these companies, if they're worth anything, which they're probably not, need to take a massive haircut, man. The barber needs to get in there, trim that thing up, pull out the razor blade, just cut all that nonsense off.
Get the back of that neck. You know what I mean?
The back of the neck.
Got to get the back of that neck. Agreed. That's a wrap for me.
Yeah, thanks for hanging out today. Hit us with some listener mail, skippydoogles@gmail.com. Check out the new book by Morgan Housel, same as ever. Quality read, super fast read. Read it this week. Check out charitywater.org. I ran into Scott Harrison this week, the founder. His story is fascinating. And effectively, folks, 52% of all disease in Africa is caused by dirty water. There's an easy fix if you want to dig into that. I was impressed with his talking points. 100% of donations go to solving the problem. So that's cool. And we do offer premium subscriptions. If you want to support the show, you can find that at skippydoogles.supercast.com. Did I miss anything, Doogles?
I think you got it.
We appreciate you hanging out with us. This is our 150th episode.
It's wild.
Amazing. Talk about upsets. Holy cow.
Love it.
We'll see you guys next week.